Welcome to exclusive YouTube tutorial here on the Investors Podcast Network. My name is Dick Broderson, and I'm here with Mr. Adam Mead, the author of The Complete Financial History of Berkshire Hathaway. Welcome to the show, Adam.
Thanks, Dick. It's really great to be here.
So, Adam, I invited you here to teach our viewers how to value Berkshire Hathaway. So, without me rambling on, why don't I just throw it over to you? And please go ahead with your presentation.
All righty. This is great. So I'm gonna present my screen here, and I put together this Excel workbook that I'm happy to share with your audience. And so if you can see my screen.
Yeah, perfect. And we'll make sure to link to this in the show notes. So just below the video, we'll put a link and people can download them for themselves.
Awesome. So, and I'm going to piggyback on your show with Chris Bloomstrand, and I've learned a ton from Chris over the years, and so it won't surprise you that our approaches are similar, and I've intentionally tried to add on to what Chris presented. So you can have some consistency here, although my analysis will be a little bit different. I've tried to be conservative, but at least give you my thinking as well as some of the reasoning behind some of these things. So I will present the same four basic techniques, some of the parts, this two-pronged approach or two-column method, the Gaap-Adjusted financials, and then a simple price to book. And I have a couple other little things to add here too. So first of all, I'm just starting. We'll start at the sum of the parts here, and I've included Berkshire's current market cap as of yesterday, or actually this says the 15th, but it's actually as of yesterday, and then the shares outstanding, and that will feed into this model. And so starting with the sum of the parts, we're breaking up Berkshire. It's a decentralized operation. We're breaking it into these parts and saying, what is each component part worth, and bringing it all back together. So I like to kind of think of this in terms of certainty. And so you have most certain at the top, cash, and then you have some of these other things at the bottom here that are maybe less certain or have at least a little bit more moving parts. So just starting at the top, cash. Now that's pretty simple. How much cash is on the books? But let's not forget that the accounting is very important here. And so you've seen this a couple times on Berkshire's balance sheet, Stig, where Berkshire has the cash listed up top, and you can see that. But then they also have this payable down below. And so it's important that you deduct at least for the first quarter of 2021 and make sure it's not there in other instances in which you value Berkshire, the payable for T-bills. So I've removed that from the cash up top because it's cash that's going to be going out the door after the balance sheet date. So that's pretty simple. And of course, cash is worth 100 cents on the dollar. So that's how we get to this. I've also included the percentage of Berkshire's current market cap to give us an idea for, again, that certainty, as well as just, kind of how much of the pie have we already taken up here. Bonds, same thing. You can pretty much value those at par. When we get into the investments, here's where some of the adjustments, the thinking that goes into this is important, and you might differ from other analysts that approach this. And so my analysis will be a little bit different than, say, Chris's. But we start with what's on the balance sheet, and I've noted here that the 13F filing of Berkshire's stocks are only U.S. listed stocks, and they include Kraft Heinz. On Berkshire's balance sheet, Kraft Heinz is listed as an equity method investment, and I've included that separately down below. So
yeah, and if you could just, for those of us who are not too proficient in accounting, whenever you say equity method, what does that mean?
Sure. No. So equity method. There's sort of three basic ownership levels of a corporation. One is if Berkshire just owns shares, a couple percentage maybe of the company. those get valued at market. They go right on the balance sheet. When a business is 100% owned by Berkshire, those go into assets proportionately, and they get their own line items on the income statement and so forth. In the middle, when Berkshire owns over 20% of a company, it's included as what's called an equity method investment, and so it's included separately on the balance sheet. The net equity that's attributable to those investments, as well as the earnings from these investments, are listed separately. So because Berkshire owns about 26%, 27% of Kraft Heinz, it just grabs its share of the income and its share of the equity on the balance sheet and puts that on its financial statements. And so it's important when we're looking at the investments here to understand what we're looking at. And so again, that 13F that everyone analyzes when it comes out once every quarter, that includes Kraft Heinz. But what we're saying here is using Berkshire's financial statements, I've not included it. I've included it on a separate line item.
Perfect. Thank you for elaborating on that, Adam.
You're welcome. So what I've done here, Stig, and I'm sort of following some of Buffett's logic over the years, and just thinking through of how to go about this. Um, so this 282 billion comes right from the balance sheet, and what I've done is I've removed the deferred tax liability. So if Berkshire were to sell its investment portfolio, it would have, in this case, about a $37 billion tax bill. Um, Buffett has hinted, and logic would seem to indicate that that is something that should be deducted when you're trying to do a sum of the parts analysis. Now, here's where you can start to tweak or quibble with my analysis or change it around. I've used a 21% tax rate. There could be an argument made that this tax is maybe paid in the future and you could discount it, so it should be lower. You might say, well, geez, taxes could increase in the future. We should increase that tax rate. So I've used 21% just for simplicity, but this is where the inputs to your model are so important, and it's not just anybody can do the math, right? It's thinking through the inputs to the model. So that's one that's fairly straightforward and less controversial.
If I can just add one quick thing to this, Adam, I'd say that using 21% is probably the most conservative metric whenever you're looking at this, because you can look at something like Berkshire Hathaway's investment in Coca-Cola, right? So Buffett bought 400 shares of Coca-Cola, split adjusted now, and I think the cost was 1.28 or something like that billion, and now it's worth more than 10 or whatnot, $12 billion. And so a lot of that is, you could say that Berkshire Hathaway has sort of like got support from the government in terms of compounding that, because it's on the deferred taxes that they're still making a return, every time that Coca-Cola is compounding for the company. And so I don't think there's anything wrong with using 21%. I actually think it's a really good thing. We like to have a margin of safety, but it's just to say, like, if you want to make adjustment based on like how to think on this, you can make the argument that it's a conservative metric. And for that reason, you should be using a conservative metric, but just really to understand like what is it that it represents.
Yeah, that's a great point, Stig. And understanding how the tax code works and the benefits of time and all of that. And yeah, I happen so the precise figure is 1.299 billion for Coke's
Oh,
cost
wow.
basis. I've and just a little plug for the companion website to the book. It's called The Oracle's Classroom, theoraclesclassroom.com or brkbook.com. I've written a blog, actually two blog posts that actually use. I'm glad you brought up Coke. I use Coke's, growth over time in value, and actually show the value in the deferred taxes using Coke as an example. So I can provide a link to that, or if viewers want to search for that, they'll find it on the website, because it's really helpful to understand that it seems like Berkshire's getting an unfair benefit by actually taking advantage, quote unquote, the tax code. But in fact, Berkshire's success translates into more tax dollars for the U.S. government over time,
Yeah.
which is sort of the second part of the equation that people kind of tend to forget about. So going on here, that again just shows you, even as we're sort of still at that uh, market, investments are valued at market, and yet there are still things that you need to make adjustments for it and be aware of. That it's not overly complex, but you do need to put some thought into it, and just see how those changes affect your value. And that's why I've given this percentage of market cap to show everyone really just how much we're looking at. The 3% of the market cap that's made up with bonds. We don't need to spend too much time on that. But the other thing with the investment, Stig, is this valuation adjustment. So in looking through to Berkshire's investment portfolio, of course, now Apple is 40% of their portfolio. Some, and I would be in this camp, would say that Apple has perhaps run ahead of itself, and so it's important to look through to Berkshire's balance sheet and say, uh, are these stocks, is this investment portfolio actually worth what it's quoted at? And you can make an argument that perhaps it's overvalued, especially when you look at Apple. So I've just used a somewhat arbitrary 10% deduction here. Again, you could use another percentage. You could go line by line and say, I'd like to look at Apple and Coke and American Express, and actually go line by line and put a value on these investments. And that's a perfectly appropriate approach. You could use this spreadsheet and add some lines in there to do that. I've tried to keep it pretty simple here just for this presentation. But again, you can, the whole what is analysis but breaking things down, and you can go really fine on this if you'd like. Just as sort of a related here, when I've looked through to the portfolio just using publicly available information, and I'm gonna just quickly switch my tab here. Um, when I pull the 13F, and I've just used Excel
And
built
Adam,
in.
could you just quickly, whenever you're saying 13Fs, in
Yeah,
this
sure.
space, we tend to use a lot of technical terminology. What is a 13F?
So the 13F, it just refers to the Securities and Exchange Commission filing number that companies and some individuals have to file with the SEC when they have more than 100 million of investments. And so Berkshire, because it owns so much by way of investments, has to file with the Securities and Exchange Commission within 45 days after each quarter. Um, and so it's all public information. You get to look behind the hood and see what Berkshire owns. And so that's how I was able to find that 270 billion that I referenced before. Um, so what I've done here is I've used Excel's built-in stock and analysis tools, which can give you the earnings of stocks. They can give you the current price, and I've given you this here. So what I've done, again, just using publicly available information, not making any adjustments to the financial statements of any of these companies, looking through to what Berkshire's share of its investees' earnings are. So Apple, you can see that using Apple's earnings per share, Berkshire's roughly $100 billion investment, quoted market value investment in Apple, is generating $4 billion a year in earnings. Now, only part of that is paid out in dividends. So what I'm saying is uh, all of that 270 billion is only generating 11 billion. So you can conclude from that the portfolio might be overvalued. Now, 2020 was kind of an odd year because earnings were depressed because of COVID and the pandemic, and I've made some adjustments to that later. But this is a technique that your listeners and those that are looking to value Berkshire should use to really just sort of give a check on that investment portfolio and understand what's going on there. So I'm going to go back to some of the parts here. So that's the investments. The equity method investments here. I've chosen to use the balance sheet value of these investments. You could choose to use the earnings from them and then capitalize them, like we do for some of the subsidiaries down below. Um, Either method is appropriate. And again, with Kraft Heinz, as I've mentioned up above, it's included in the um, in that 13F filing, but um, it's valued at par there. Berkshire, because it's an equity method investment, values it uh, at book plus or minus dividends or earnings. So today it's pretty close, but in the past it has significantly been either above or below what the quoted market value has been. But today it's pretty much on par. And this line item, Stig, is primarily Kraft Heinz. Then you have Berkshire's investment in Pilot Flying J. Energy Transmission Texas is a little business down in Texas that Berkshire Hathaway Energy owns, and then Berkadia is a 50-50 split with a partner. Now we get into sort of the big buckets here, and so Berkshire owns Burlington Northern Santa Fe, the railroad, and what I've done here is I've normalized these earnings. So this 5.5 billion here is my saying, and what I don't have here, Stig, is the history of some of these operations. But it's important to look at the history of say the Burlington Northern Santa Fe Railroad and say what has it earned in the past, and is its current earning power reflective of a normalized value. And so what this 5.5 billion here is doing is just saying conservatively, but looking through, I think the Burlington Northern Santa Fe on a net basis, and you could look at this pre-tax, but I've used net, will earn about 5.5 billion. Again, you could argue that it's too low, perhaps. It is a little bit higher than last year just because of COVID and things that were had affected it there. But its normal earnings power, I'm saying, is 5.5 billion. Now, um, I've used 15 times net earnings for my valuation here. Again, I think it's conservative. And one point I want to make here, Stig, is I tend not to look at market comparables so much. I tend to say what would I like to get from this business, because what I have different from every other investor out there is my opportunity cost set. And so it may be appropriate, and you may look at the Union Pacific Railroad, which is the Burlington Northern's primary competitor in the West. They share very similar territories, and they're very similar in terms of size. And say, geez, the Union Pacific Railroad um, is valued at say 20 times earnings. Therefore, Berkshire's railroad is worth 20 times earnings. And you're not wrong in saying that. I just think that if the market changes, you're by saying that Berkshire's railroad is worth equal to say a comp, you're giving the market say over your valuation. What I'm saying is I just want to look at this, forget about the market, pretend the market didn't exist. How much do I want to get from the Burlington Northern Santa Fe? And so I'm okay. I've chosen 15 times net earnings. Um, Burlington Northern, it's a regulated entity. It has predictable, sort of consistent, almost utility-like earnings that will probably generate this low double-digit return on equity. But it's so important to understand that the discount rate that you apply to a valuation, and by inverting that, the multiple that you put on a valuation, that implies your future expected return. So if I'm saying, for example, the Burlington is worth 25 times earnings, um, I'm what that implies is that I'm saying I'm okay with a 4% return, right? So I think where folks can get tripped up sometimes to say, geez, this is worth 30 times earnings. And it may be on a business that has superior growth and reinvestment potential, but for a straight sort of, again, almost boring business, right? The Burlington Northern Santa Fe Railroad, um, it's a good business. But I'm saying that I want a 1 divided by 15, roughly 7% return from the Burlington.
Yeah.
That's
And
kind of how I come up with that. That's my thinking process behind using that multiple.
it's such a great point, because so many people would point to something like Union Pacific, and whenever you're looking at that, it's trading at such high multiples right now. So we are recording here the 23rd of June, and the free cash flow is what, a seven and a half uh dollar per share, and they're trading at 220. So we're talking about close to a 30 times free cash flow. And probably one of the reasons for that is because it's trading like a bond, and it's not really trading like a bond. But the reason why I'm saying is that so many people are seeing how stable the numbers are, and giving the current interest rate level, some people would say, well, it makes sense for their type of portfolio. They're probably not 100% exposed to this stock, but they might have basket of these types of stock. Very stable dividend. It's something a lot of people like to see, and they want to pay extra for that. So whenever you add something like that up, you could say, well, it sort of makes sense given the my conditions, which are a bit odd these days. Well, that's what we should be doing. But what you're saying is no. I kind of feel I should be getting 6-7%, something like that. And that's your opportunity cost. So that's why you're using that multiple. And in any case, and I'll just like to point that out, I really like how you tend to be conservative in all your metrics. Like, if in doubt, use the more conservative metric. And so I just wanted to point that out there as you go through the other lines.
Yeah, thanks, Dave. Yeah, and I've tried to be conservative, and that's another way of adding that margin of safety, and just admitting that, hey, I might be wrong on the earnings or the valuation. Yeah, that point about that expected return, that revaluation, and if you take it to the extreme and do the math and say, geez, if this business, just pick any business, but if you wanted to pick the Burlington Northern Santa Fe, if it's worth, just use an extreme, um, 30 or 40 times earnings, do the math and say, okay, if I'm buying it at X, and you only get that one time pop between that valuation jump, and you only get that if the market agrees with your assessment of the multiple. But if you own this business for 20 years, like Charlie Munger says, your your stock return tends to converge with the underlying return of the business. And so, what I'm really advocating and trying to put a exclamation point on is look at the underlying business, and just imagine that you're the one receiving that cash. And what are you going to get? What are the the true growth potential of the business, irrespective of what the market is saying a competitor might be worth. So I'm doing that same thing with BRK Energy. Um, incredible collection of assets. And Buffett has even said that the energy business is a place to stay rich. It's not a place to get rich. And so it has a regulated return. It varies based on based on market and regulator. And there's certain tax credits that come from into the energy business. And if you look at Berkshire's financial statements, you'll see that the net earnings are actually higher than the pre-tax earnings because of some of the tax credits that Berkshire Hathaway Energy is able to generate. Um, Now, and here's I just want to highlight and the detail that Chris Bloomstrand went into on his presentation, and just some of the quirks that come with Berkshire's accounting. The BYD shares, and BYD is a Chinese Chinese electric car manufacturer, an investment that Charlie Munger pushed Berkshire to make. That investment actually resides on the books of Berkshire Hathaway Energy. It, for many years, was a small part of the value, but in recent years, it's really run up. I've not included it. I've made no adjustment for that. I haven't pulled it out separately to add it back. You're certainly appropriate in doing that. And I think that's what Chris does. I've used the earnings of Berkshire Hathaway Energy, and because BYD is a relatively small part of that, I've said let's not try to go that deep. Let's look at the big picture here and focus on what the main energy assets are worth. Same with the manufacturing, service, and retailing businesses. I've used a 15 times earnings multiple here. You might argue that this 9 billion is a little bit too low. I'm sort of assuming that the challenges, say, with Precision Cast Parts, which is a manufacturer of airplane and aerospace components, Berkshire Hathaway took a $10 billion, $11 billion write down related to primarily to Precision Cast Parts last year because of the challenges in the airline industry. I'm saying, and I'm implying here, that there is perhaps some permanent impairment to some of these businesses, which again I'm trying to be conservative. But if this number is 10 billion, you wouldn't be wrong in saying that. But I think here's roughly what I think it's worth. And with all of these businesses, I'm not trying to project out, say, future growth potential. It's important to understand that what I'm saying is that these businesses are pretty good businesses. They're going to earn a good return on capital, but it's really the current earnings. What I'm saying is, how much cash can these businesses give me today? And that's what I'm primarily focused on. And so the actual future deployment of this capital, Stig, could come in any manner of ways. The Burlington Northern Santa Fe Railroad has largely completed its sort of expansion in terms of double decking its trains, reinforcing bridges, expanding tunnels. It soaked up a bunch of capital in years past. It's probably done that sort of extra reinvestment. Berkshire Hathaway Energy has a ton of runway, and that business can just absorb a ton of capital. But that capital can come from the manufacturing, service, and retailing businesses. It doesn't have to stay in that bucket. But what I'm saying is that Berkshire Hathaway as a whole, as a conglomerate, having this fluid reinvestment opportunity set, can move capital where it's most appropriate. But on the whole, it's going to have a pretty average but good reinvestment slate. When we get down to this next line item here, insurance underwriting. So on Berkshire's books, the insurance business is listed separately, and even at a high level, it's still kind of skewed in terms of how it's all put together. But what we're saying is, even though the investments reside on the insurance company balance sheet, we're giving them a separate value. We're assigning them a separate value. The insurance underwriting, what I'm assuming here is that Berkshire can, on a normalized basis, generate about 60 billion in premiums at about a 3% normalized underwriting gain. I believe Chris Bloomstrand has used 5%.
Yeah.
I've just chosen to use 3%. It's probably more in line with I think they generated about a 4% underwriting gain pre-tax from maybe the last 15 years. I'm just saying I think it may be harder to generate those underwriting gains because of competition and the way that capital has flooded into the industry. It's just the way I've approached it. And again, I've said, okay, well, it's capital coming in. I think it's maybe worth 15 times. So that's how I've come across that there. And then of course we're looking at the parent company and saying there's some debt at the holding company level. I'm going to deduct that from the total. And again, just to kind of circle back, it's important to recognize that most of these businesses, and specifically the railroad and the energy businesses, have debt on their own. You could certainly take the approach of valuing the assets and then taking out the debt. You can actually go and look at the Burlington's separate 10K. Same with the energy business. You can look at their separate 10K. But what I'm implying here, Stig, just by using this approach, is that I'm okay with the debt levels at those businesses, and it's just important to sort of be explicit on that and recognize that this holding company debt is just something completely separate. It's a complete different capital allocation decision that Berkshire has made to fund its investments. And so we get down to the bottom here, and what I'm saying based on this is that based on Berkshire's current market cap, its value is about 106% of its market cap, which would lead you to believe that Berkshire is slightly undervalued currently. And I've given you here the per share figures as well as a value to book metric as well.
Amazing. So thank you for doing that. B shares, probably what most viewers are holding. These are a bit more easier to come by than the S shares. So 292. Just to sum up, for the approach, that's the number that is fair to use.
That's the number that this model kicks out, and when you're buying that, kind of forget about the share class and say, "Geez, I can't afford an A share." There's such minor differences between the two; they're economically equivalent, and so
Right.
buying the B share at 292 or saying it's worth 292 is saying it's worth 439,000 per A
Exactly.
share. And you're saying that Berkshire as a whole is worth 668 billion. You're saying all of the same things by saying that, and there's no benefit if Berkshire split the B shares, 100 to 1, it wouldn't change anything. So that, and I wanted to spend a lot more time on the sum of the parts because a lot of the same thinking goes into some of the other approaches.
Perfect.
So
Yeah. Let's jump to the two-pronged approach.
So the two-prong approach, or the two-column method, as it's sometimes been referred to, um, Buffett in his letters has used per share figures for this, per share operating earnings, and per share investments. I've chosen to continue the logic that we've built in the sum of the parts and use a company level analysis, and then at the end say what things are worth on a per share basis. But you're certainly appropriate in starting with the per share figures to do this. So this same 138 billion for cash, I'm saying is the same as the sum of the parts, same with the bonds, and same with the investment. So we've already done that work, and our analysis should be consistent, right? So I'm going to use this same 375 billion that I came across here in the sum of the parts approach. Then it comes down to, so we sort of take all of that off the table, and we can go to Berkshire's earnings. And so you can this right here, results of operations. This comes right from the in this case the 10K. And I've in for this approach I've used the year end figures just for simplicity's sake. What you could do, and what I do for my own, is map this quarter by quarter and then use a trailing 4-quarter approach. So you could take the 2020 figures, add in the first quarter of 2021, take out the first quarter of 2020, and you'd be left with a full year, shifted forward to the first quarter. You could certainly do that. I've said, let's start with 2020. And what I've done here is I've listed the actual figures, and then what I've done is normalize them. What I'm saying for insurance underwriting, again, this 1.8 billion, same with the sum of the parts. I've said the underwriting perhaps in 2020 was actually a little bit low. I think that they can earn more. Same with the railroad. You can see what the actual figure was versus what I've used for a normalized figure. Utilities and energy, I've bumped that 3.1 billion of earnings up to 3.5 billion. The MSR businesses clearly are under earning based on last year. They were hit very hard by the pandemic. And again, there may be some capital impairment permanent permanent impairment to value. So those are pretty straightforward, defensible. You may change them yourself slightly. Then we get into the accounting versus the economics here. So Berkshire had this 11.3 billion in other, which we can see is right over here, and what I'm saying here is, because I've accounted for perhaps this normalized earnings on the MSR businesses, this collection of multiple businesses under this category, I've said that they can earn 9 billion, which might be conservative. This 11 billion that Berkshire wrote down, I'm saying is a one-time non-cash event that it's appropriate to add back. And so that's what this adjustment does here in the 2020 column. And of course, if we have a normalized in the normalized column, this is already a 0, and so I'm not going to add it back again. And so what this is telling me is that the earnings, the after-tax earnings from 2020 of about 16.9 billion, maybe on a normalized basis should be about 20 billion. I've then taken the same multiple that I used in the sum of the parts, and I've said, okay, Berkshire's operations are worth, just a tad under 300 billion. And so I add the investments, and I'm just using that as a catch-all for cash, bonds, equity method, and the stocks here, and saying that it's worth, as a whole, 672 billion. And so that translates into a slightly higher B share value here versus the sum of the parts. And so I made this little note here. These figures up above are just the cash, bonds, and investments. When I'm including down here is the equity method investments, and so and also we're not including this valuation method does not deduct the parent company debt, and so that's why you have that slightly higher value here, Stig. A variant of this is what I've called, so this is sort of like, 2B here. I've called the implied yield method. And so I take Berkshire's market cap. I say, I'm assuming that this bucket of cash, stocks, bonds is worth 100 cents on the dollar. If I were to buy Berkshire Hathaway in its entirety and pay the 630 billion that the market implies it's worth today, I could sell all of this other stuff, get 375 billion, and I'd be left with a cost of 255 billion. What that implies for me is, based on the actual earnings, about a 6.6% earnings yield. If I normalize the earnings to that 19.8 billion, I'm saying that I could get a 7.8% yield from buying Berkshire today. And again, that is consistent. If we just want to do a quick change this into a multiple, this implies about a 12.9 multiple on the earnings. So that's again consistent with our other method of valuing Berkshire. Then I'll move on to Gaap-Adjusted financials. And so we're using, and again, I'm using 2020 for simplicity, but you can certainly adjust this to the current quarter and make any adjustments that you think are appropriate. And so what I'm doing is I'm starting with Berkshire's GAAP earnings, and what I've simply done in this first section here, Stig, is just transferred all of those numbers into Excel. So you can see where I got these first numbers up above. Then again, kind of like the other approaches, I'm saying we're going to remove the investment and derivatives gains and losses. And it's important to do that because the accounting rules recently changed and made it such that all investment gains, even unrealized and realized, have to flow through the income statement, and it creates a lot of noise from quarter to quarter and year to year that are not conducive to a proper valuation of Berkshire. And the other reason why I'm doing this is because I'm looking through to the earnings down below, and I'll get to that in a minute.
Adam, just to quickly jump in here, I think that's important because a lot of people, whenever they are like figuring out like how are Berkshire Hathaway performing, they go to the news, and the news report the Gaap earnings, and as you said, like they're all over the place. The stock market might have gone up 10% or go down 10%, and all of that is reflected in the income statement. So you have these extremely volatile earnings, which is not a true reflection of the state of the company. So Warren Buffett has said multiple times, if you want to really understand how well Berkshire is doing, look at the operating earnings. And even though that you have some fluctuations in the operating earnings, generally they're a lot more stable. And so that's it's what you should be looking at. And then, well, I guess people should be looking at your approach, but I'm just trying to make this very simplistic. Like, look at the operating earnings, just one, and then what you talked about with the implied yield method, and then all the others. Warren Buffett has had that approach for several years in letters, and then for some reason they disappeared. But if you really want to make it very, very simple, that is one way to look at it. Having those two buckets.
Yeah, that's right. And the two column method um, is really back of the envelope, and you probably shouldn't buy Berkshire based solely on that. But you should understand what goes into it, and also understand the accounting. And we're so lucky to have someone like Warren Buffett teach us through his letters over the years to say, I'm not trying to make the stock price go up. I'm not trying to paint a rosy picture. I'm trying to give you the economic reality that is Berkshire Hathaway, and we have to speak this language, which is the accounting. And oh, by the way, the accounting. We're going to do all of the things that we need to do for the accountants. We're going to put the numbers where they need to go, but you should understand that accounting requires, for example, us to flow through the changes in the stock market portfolio when those are very volatile. And so we're so lucky to have Warren teach us this accounting, and as part of your regular approach to valuing Berkshire from year to year. And there's no shame to use Modish Pabrai's term, shameless cloning. Um, Chris Bloomstrand, I mean, he is just a master at Berkshire, and anybody should read his letters. Semper Augustus. He lays this out way better than me, and goes into all of these approaches and all the detail that you could ever want. But I'm gonna give your audience the spreadsheet. If they want to make it their own, there's no shame in doing that. But what's important to understand is, again, what's going into that model. And so there may be an accounting change in future years, Stig, that listeners and folks valuing Berkshire should understand, that changes the accounting, and you should adjust your model accordingly. And if it's not Warren Buffett or maybe Greg Abel telling you what changed, just go to the 10K and look at, they call it recent accounting pronouncements, and just find out what changed. And it can be intimidating to open up a almost 200-page 10K, but uh, just just dig in. And Buffett has said that if you can't understand it, the company's probably trying to make it so that you can't understand it. And you can trust Berkshire's financial statements, you can trust their auditors, and you can trust that when you look into the accounting changes, you should reasonably be able to understand it. So just to put a point on that. So what I've done here, these next series of adjustments are, one, underwriting. So I'm normalizing that underwriting, and again, that's just bringing it to 1.8 billion. Same with these other categories: the rail, the utilities, and the MSR businesses, just adjusting those to what I think are a conservative normalized value. And then here's where you can get differences can arise, or different ways of looking at this. Uh, looking back and saying, okay, what we've included up top here, and it's important to recognize that Berkshire's already including investment income up top, and most of that, because interest rates are so low, most of that is the dividends that come from its investees, from the stock portfolio. And so that is only the part of the iceberg that shows up on Berkshire's financial statements, because accounting only shows us the dividends that Berkshire receives from its investees. And so what I've done here is I've taken that 11.2 billion from the 13F, this 11.2 billion, I've taken that and I've said, we've already accounted for most of it up here. I'm going to add back into Berkshire's earnings on a look-through basis 6.1, almost 6.2 billion of retained earnings that they don't show up anywhere in Berkshire's financial statements. They're just reflected in the value of the companies over time. Now what I've done, and again, this is subjective, I've normalized the retained earnings of the investees. I've said, I think that they're underreporting earnings by roughly 3 billion. And so that gets you to a maybe $14 billion run rate for the look-through earnings for Berkshire's investment portfolio. And if you took it on at face value, that 280 billion, you'd say, geez, that's 20 times earnings. Based on the adjustments that we've made, that multiple is probably somewhere closer to the 15. So again, it's consistent with how we've approached our valuation elsewhere. The cash that Berkshire has and its value. And when we're taking this approach, again, because Berkshire is not it's earning a pittance on its cash now, Stig. What I've said, and you'll notice that this $100 billion that I've listed here is far less than the $138 billion that they have. You can get, Buffett has said that they will not go below 20 billion of cash because of the insurance operations that they have on the balance sheet. He said he's even so that 20 billion is stated in the 10K, but he's effectively said that that's much higher. So I like the way that Chris has approached it and said, geez, let's look at a 1 year of Berkshire's payout in terms of its insurance payouts, regardless of premiums, just what it would have to pay out in sort of a worst case year. Maybe that number is closer to 40 billion. It could be even higher. It could be as high as 70 billion. But I've just knocked 38 billion off, and I've said, okay, the other approaches value the cash at 100 cents on the dollar. We need a method to assume that cash could generate some earnings for Berkshire. And so I've assumed 5%. Again, it's conservative. Berkshire's probably not going to put out cash at something less than maybe 9 or 10%. So it's going to sit there for it could sit there for a little while. And so maybe on a present value basis, that 5% is more appropriate. But again, you could use 6, you could use 7%. And again, thinking back to your excellent episode with Chris, his way of thinking in terms of translating that cash into future earnings power and saying that if anything changes, I don't need to make an adjustment is a really great way to look at it. I've tried to do this pretty simply here. The other thing here with Berkshire, just this last item, is the intangible amortization. So Berkshire, it doesn't amortize the goodwill, simply the excess of purchase price that Berkshire's paid for certain investments. It doesn't amortize or take a charge for this excess that it pays on a pure goodwill basis. But there are certain items, for example, if Berkshire acquires a company that has some software in the books or it has some customer relationships, accounting rules require that those are given a finite life and amortized into earnings. In thinking through what those intangibles are, say customer relationships, Buffett has talked about this. I've internalized the reasoning behind it, and I'm saying those intangible expenses that Berkshire has on its financial statements are not reflective of economic reality. So I'm going to round numbers, add back $1 billion from the expense, and of the 1.277 billion of total intangibles, I'm saying only maybe 300 million represent real diminution of an asset on Berkshire's books. So when you add all of that up, you get 40 billion, roughly 40 billion. Again, I'm using the same 15 times multiple, and um, you're getting a slightly lower value here. And so I perhaps could refine this. I could one major thing that's affecting this here is I'm taking the 100 billion of cash, only saying it's going to earn 5% and then valuing it at the 15 times. If you were to remove that cash from the top and then run this exercise and say, market cap less cash and then value the earnings, you might get a higher value. So this was actually the lowest of the approaches, and I'll sum those up in a minute. But you can see what the economic earnings of Berkshire Hathaway would look like on a pretty conservative basis here.
Perfect. And Adam, let's go to the final valuation approach, the simple price to book. And one of the reasons why I find this really appealing is that for those of us who might not be too into accounting, and I should be careful what I'm saying here because I actually wrote an accounting book, so I don't know if I can put myself into that category. But whenever a lot of viewers are like seeing like the Gaap-Adjusted financials and like, oh my god, like that looks intimidating. Perhaps they've digged into some of Warren Buffett's letters, and he talked about the price to book. He might at some point in time it was like 1.1, then he increased it to 1.2 price to book. He was willing to do that, and now it's a bit more floating. He's been doing a lot of that recently, which I know you're gonna go more into later, and why that has changed. But perhaps this approach is a bit more approachable for a lot of our viewers. So having said that, let me throw it back over to you, Adam. What is it that we are measuring whenever we are saying price? Well, we know what price is. What is book here?
So Berkshire's book value is simply the net equity per the financial statements. So in this case, Berkshire at the end of the first quarter 2021 had about 448, call it 450 billion of equity capital. Now that includes goodwill, so it's important to recognize that includes goodwill. You could get fancy here and value Berkshire on a price to tangible book. That's a decision that you have to make as an analyst. But just a simple price to book. And what I have here, Stig, is the 55-year history of Berkshire's price to book, which I've included. I used and found this from my study of Berkshire in writing my book. And you can see early years, it really traded, especially knowing Berkshire's future trajectory, traded below book. I mean, this is just an incredible period, but probably justified. I mean, people didn't know who Warren Buffett was. They hadn't proved themselves in the insurance business. Once that became apparent,
And if we can say that, Adam, like the business weren't that great. Like Berkshire Hathaway back in the day, it was a bad business. It was a capital intensive poor return kind of business. It wasn't the type of, it wasn't the Googles and Apples of the world. It was it wasn't one of those where you're gonna pay like a really really high multiple to some kind of intangible algorithm kind of thing. Like these were like physical, capital intensive equipment or whatnot they had. And it was horrible. I don't know if it was point 0.5 horrible. Buffett bought a lot back at that price, but it wasn't a great business. Let me just put it like that.
Yeah, it really wasn't. It was, and it just makes it that much amazing what Buffett did, right? I mean, you talk about, maybe changing the engine in a car going down the road, but he took um he took a Titanic. I don't know, this analogy may be terrible, but he took an old sort of sinking ship, and while it was floating down the river, melted the steel down and created this beautiful yacht, right? Like to take that capital from a dying textile business and recycle it into an insurance operation, which itself struggled in the first decade. Um, Bought a bank, bought some of these better businesses. It didn't become apparent, at least to the market, until later, and you can see, from this mid '70s all the way up to the mid '90s, the combination of Berkshire itself doing very well and the market placing a high premium on that success really ran the price to book up well over 2 times. And of course, Chris covered in depth with the Gen Re acquisition in '98, where they paid, used an overinflated currency to buy that. Was probably a high point. But then you see this settle down into, and I've just highlighted here the last 2010 to 2019. It goes a little bit further, but it's roughly where we are today. Um, 1.4, 1.5, that's generally where it's traded. It's been pretty consistent over the last five five-ish years, um, with the exception of the market gyrations in the early 2020. But this really should be used as a check, and you may use this. You may do the other valuation techniques on an annual basis, and then just say, okay, nothing really major changes on Berkshire from, say, quarter to quarter. I'm going to do all this analysis, once a year when all that comes out. And then for the rest of the year, I can just use a price to book that I find appropriate. So you shouldn't just, again, if you were to buy a local business, an auto dealership or a McDonald's franchise or something, you would never buy it on its historical price to book value. So just never forget that you're buying a real business. You're buying real businesses when you're buying Berkshire Hathaway or any stock. And this should just be one tool in your arsenal to give you another vantage point to say what is this worth. So there may be in this case, certainly, and having studied Berkshire in such depth, some bias on my part to say, oh geez, let's pick 1.5 times. We got that in some of the other methods. So I've chosen this. Chris, I believe, used 175, and again, his analysis is probably right. I'm trying to be conservative here. Um, so that's how we come out. We come out to that. As sort of an add-on, Stig, and to go a little bit deeper, it's important to understand how Berkshire's book value changes and will change over time. So I talked about the goodwill that Berkshire has. That's one component of it. Um, as Berkshire shifts to a capital return policy, which includes it includes exclusively now share repurchases, the effect of that on book value, because they will be buying a share back undervalued but above book value, what that will tend to do is depress the gap figure for equity and increase an appropriate price to pay for Berkshire's book value. And
Yeah,
I've
it's a little tricky unless you're
yeah,
really into the nitty gritty accounting. But perhaps one way to think about this is that it's the shares that they're buying back is going into a negative equity account, and so you can actually lower the book value. It probably sounds very counterintuitive, but the book value would actually be lower if you are buying stock at these prices, and so. Uh, the business can be overvalued, but the book value will still continue to go down as you're spending money on that. And so, as it sounds super, super counterintuitive, but remember, your starting point is that you're trying to figure out what is the price to the book value. And if the book value goes down, like the intrinsic value or the fair value, if you want, expect to go up. And so I just wanted to mention that in case you were like, should I hope for a low, high? Like how should I see this?
that's right. And it's great to have multiple angles again and talking about that. And I probably could be more clear. I want to share an example here in just a second, but uh, a, a I mentioned Gen Re, and in the book, I used the example of a silver dollar. If I had a silver dollar, that the quoted value of that would be $1, right? But if the silver in that silver dollar were worth $1.50, the appropriate price to book would be $1.50. 1.5 times. But if I were to sell this to you and you put it on your books for $1.50, the appropriate price to book would actually go down to one, right? Uh, so,
Right.
so that's a reverse example. But I wanna try I want to try to extend this example to a hypothetical Silverco balance sheet. So, bear with me for just a second. I hope this comes through. I've said this hypothetical balance sheet here has $100 in cash. It has 100 1-ounce silver dollars valued at book at $100. Total assets 200. No debt. Equity is worth 200. Pretty straightforward. The value of this silver in this hypothetical example is $2 an ounce. So the silver in this case is analogous to the businesses on Berkshire Hathaway's books. They may be valued on a book value basis at, in this case, one. Um, but the market value, the true value of these businesses might be two. And so when you add up the sources of value, you get 300 versus the equity of two. And so I'm saying that the correct value for this is 1.5 times book. Let's pretend that this hypothetical company was able to repurchase half of these silver dollars at the $2. So the cash goes to zero, right? So we're taking 50 of these silver dollars at $2. That's $100 that's going out of the coffers of this company. All we're left with are these 50 silver dollars valued at book at $1, but still worth two. And so now our equity has gone down to 50. The value of the company is 100, and the correct price to book is actually two. And so I've tried to push this example. I've tried to make it an extreme, and I hope I hope it conveys the changes that can take place because of repurchases, because of things that happen in the balance sheet. The correct price to book may drift over time. So with that sort of side note, put together this quick table, this summary table of the different valuation techniques. Again, we see these three: the sum of the parts, the two column, and the simple price to book give us pretty close. This 261 with the Gaap-Adjusted was an outlier. But if you want to just average these and get 285 per B share, you might be even more conservative. Um, I have used, just as sort of a little side note, the share count as of April 22nd. You say, where did you get that number? Uh, when Berkshire reported its first quarter earnings on the 10Q, it includes in the body of the report what the shares were at the end of the quarter. But when you're reporting to the SEC, you need to say what your share count was as of a certain date. And so, as of April 22nd, when they put this together, Berkshire's share count was actually slightly lower than what was reported at the end of the first quarter because Berkshire was in the process of repurchasing shares. So I've used that lower figure in this analysis here. So 285 per B share implies 428,000 for the A share, which implies a value of about 652 billion for Berkshire as a whole.
So, Adam, do you have a I guess perhaps some of the viewers out there might be saying, well, what's the best method? Is there such a thing as the best method?
If forced to pick, I would probably pick the sum of the parts only because you can break things apart, think about each individual business differently. You can really see the sources of value, think about your inputs, and really what I think I've shown here is, the two column method is really just sort of a rejiggering of the sum of the parts and just looking at it maybe from two different buckets, but the ultimate inputs to your model, I think, probably are best conveyed with the sum of the parts. And then the price to book, that can be your sort of check from time to time, perhaps. Yeah, so some of the parts would be the one to go to.
Perfect. Yeah, and we're recording here the 23rd of June, and the B share right now is trading at 276. So just using that as a reference, and it's not so much like I hope people are gonna watch this video like years from now, and I mean like it's more about the method more than necessarily what's is it 276? Is it 285? That's not too important. And another quick thing I just wanted to mention, if people are interested, is that they can go into to the filings of Berkshire and see what they're buying it back for, like on split out into a monthly basis. And so I like to do that. I'm very geeky when it comes to accounting. I don't necessarily know if that's something everyone enjoys. It comes out 4 times a year, like the 10 Qs. I know we're saying like 10 Qs, 10K. So the 10 Qs, they're a quarterly filing. You have 10K, that's the annual filing. But it really tells you very interesting, a lot of interesting things. And one of the things is that Buffett, he more than anyone, together with Charlie Munger, knows what the business is worth. And so one indicator, since they only want to buy back stock at a discounted value, could be going to look into those filings.
Yeah, it's really fascinating, and what's great about Berkshire's financial statements is that they don't change very much in terms of the layout. I mean, when I've I looked at Berkshire's every financial statement that Berkshire filed, from the 1950s on, and there were changes, sure, but you get to know the flow of the statements, and you kind of get to know where you have to scroll to find certain numbers, and once you dig into Berkshire's financial statements, once and I did this a couple of years ago. It's on my YouTube channel. I spent about 5 hours going through a Berkshire 10K. But if you invest that effort, the next time will be not as much, and you can quickly go and find these fun things and see the little, see what they're buying back the shares for, see what's changed in some of the businesses, and I don't think you can. No, you can see it here. I have behind me here, Stig, every physical annual report from
Oh wow, really?
1986 to
Wow.
2020. And what's really notable is that they don't change much in size. And so, for the analysts like me, you and me, we yearn for every little detail. But what Berkshire is giving you from year to year is hopefully the distilled facts that you need to value this business and to really understand it. And it really is. I think any viewer of your podcast and of your show is certainly smart enough to go through and do it. And hopefully we've given them some confidence to do that today. And I'd be happy to help, answer anybody's questions. Send me an email, I'll look at the comments on
Thank
this
you.
show and respond. And I'm very much still a student in Berkshire, and we're all learning this together.
So Adam, if you allow me to just quickly share my screen here, and because I know I keep on saying things like, oh, you can just check the filings, and then Adam, you would know how to check the filings, and people might be sitting out there like, I don't even know where to begin. So if I can just share my screen here, so this is Berkshire's homepage. It's it perhaps it doesn't look like it's much to look at, but there's a lot of great information here. So if you look at the annual and interim reports, the latest filing here from Q1 2021, you open up here a PDF, and so like Adam said, there's they pretty much look like it. They always do, and so if you go down here, I want to say it's very near the end here, you can see the price. So again, like using here BCS, you can see like, oh, they bought back a meaningful amount. And whenever I say meaningful amount, I'm sort of like figuring out like how many percent of the shares outstanding. And I think that I would say this is a meaningful amount. I think it was around 5% or so they bought back last year. Again, this is on a quarterly basis. You have to make the adjustment yourself, but you can do that. And as far as we can tell, they're still buying back stock, which again is an indicator of not only what Adam and I are saying, but going to Oracle himself, what do he think is a good price, and if he's paying back, if he's buying back shares for 251, you can assume that the intrinsic value is safely above that.
And
Yeah,
and,
it's great
and
stuff.
that's Buffett's. If you have a business that you can that's better than Berkshire, right? Just because Buffett's buying it back at that price doesn't mean that everybody should be buying it, right? I mean, if you and I as smaller investors can find a better opportunity, it may that's using that opportunity cost approach. But one thing is, as you were going through that, Stig, I just wanted to mention, which I find enormously helpful, and I've encouraged some people to do is. Um, Go and you can look at the SEC filings right through Berkshire's website there, just as you've done. Go and pull. So the Burlington Northern Santa Fe files its own 10K every year because it has publicly traded debt. Just look at the breadth and depth of that filing at probably 200 pages, and you say, wow, this is a lot of information to take in. Then just kind of keep that in mind. Go over to Berkshire's 10K or 10Q and look at the just few pages that Berkshire gives you on the Burlington Northern Santa Fe. And what I'm trying to tell the audience is, there's a lot that's in these filings, and it's interesting for you and me to go through and look at it all, and you can and you should do that. But take a clue from Buffett and the few pages that Berkshire might put on a Burlington Northern Santa Fe or some of these other larger businesses, which might only have a paragraph. What that tells you is that there are really just a few handful of things that you need to understand about these businesses, and if you can internalize those, you know, how many freight cars did they move last quarter? What was the composition of those? What were their expenses? I mean, all those basics that Berkshire sums up in its reports in maybe a couple of paragraphs or a page, all of that comes from that huge filing. So if you can kind of just use that as an example, as a way to sort of get yourself comfortable with understanding the process of valuing the Burlington Northern, you can get comfortable with the breadth of information that it seems like you have to just absorb all of this information. But you really just need to drill down and find those key pieces of information that really drive the needle. So hopefully take some of the scare out of everyone doing this.
Yeah, and just to round this off, it's if you made it this far in the video, you're probably really into Berkshire. And so I definitely want to give a plug for this amazing book. You can also see it behind Adam. And I hope I don't embarrass you. You didn't ask me to do this. I have a lot of doggies here, and people can see that. A lot of great takeaways from you know, how to think about Berkshire Hathaway, not just as an investment, but as a masterpiece, as a business. Yeah. So Anna, thank you so much for making time to educate us about Berkshire Hathaway. We really appreciate it.
Oh, you're welcome, Stig. And yeah, so I'm happy to share this spreadsheet that I had today, and I've actually released on the oraclesclassroom.com. You can find the 200 plus tab Excel that went into the book that I actually used to create some of these tables in the book. I've given that out there as a way of giving back to people. So check that out, and happy to answer any questions.
Perfect. All right, we will make sure to link to all of that in the show notes. And yeah, that's all we had. Thanks for watching.
Thank you, Stig. This has been a lot of fun.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.